Imagine waking up in a world where money quietly shows up whether you work that day or not. No rush, no panic, no checking your phone first thing in the morning to see if your paycheck arrived. Instead, you open your brokerage account and see dividend payments sitting there, waiting for you. Not because you sold anything, not because you got lucky, but because you own income-producing assets. For most people, this kind of life feels abstract, almost fictional, like something that only exists in finance books or YouTube thumbnails with Lamborghinis in the background. But the reality is much simpler and much less glamorous. Living off dividends isn't about hype. It's about structure, it's about math, and it's about patience. My name is Quinn, and welcome back to Quinn Invests US. On this channel, we focus on realistic wealth-building strategies that normal people can actually execute. No shortcuts, no fake promises, just systems that work over time. Today, we're going to break down the fastest realistic way to live off dividends, specifically how to generate $2,900 per month, or about $35,000 per year in passive dividend income. For some people, that amount replaces a full-time income. For others, it covers all basic expenses, and for many, it creates the option to work on their own terms. Before we talk strategies, we need to reset expectations. Dividend income is not about getting rich quick. It's about getting free slowly, free from stress, free from paycheck dependency, free from needing permission to live your life. And the first step is understanding how dividends actually work, because most people misunderstand them completely. When you buy shares of a company, you're not just buying a ticker symbol, you're buying ownership. If that company earns profits, management can either reinvest those profits into growth or distribute part of them to shareholders. When they choose the second option, those payments are called dividends. That's it. No magic, no tricks. Dividends are simply profits being shared. And the key difference between dividend income and selling investments is this. When you sell, your asset shrinks. When you live off dividends, your asset stays intact. That distinction is everything. Think of it like owning rental property. You don't sell the house every month to pay your bills. You collect rent. Dividends work the same way, just without tenants calling you at 2 a.m. Now let's talk about the actual goal. Generating $2,900 per month means your portfolio needs to produce about $35,000 per year in income. The amount of money required to do that depends entirely on yield, which is where most people get confused. Dividend yield is simply the annual income an investment produces, divided by its price. A $100 investment that pays $5 per year has a 5% yield. Higher yield means more income per dollar invested, but it usually comes with trade-offs. Higher yield often means less growth potential, more volatility, higher risk of dividend cuts. Lower yield usually means slower income growth, more stability, stronger balance sheets. There is no perfect yield. There is only what fits your goal. So let's walk through 3 realistic approaches to hitting $2,900 per month. Starting with the fastest, the first approach is covered call ETFs, and this is where a lot of people start paying attention because the yields are high. Covered call ETFs work by holding stocks and selling call options against them. When those options are sold, the ETF collects premiums. Those premiums are then paid out to investors as income. In simple terms, the fund is trading some upside potential in exchange for immediate cash flow. That's why yields here can sit around 10 to 12%. Funds like XYLD, OILK, and EWZ fall into this category. Over recent periods, these funds have produced yields close to or above 11%. At an 11% yield, you would need roughly $315,000 invested to generate $35,000 per year. That's fast compared to traditional dividend investing. But here's the part you need to understand clearly. Covered call ETFs are income tools, not growth engines. They work best when markets move sideways or moderately upward. In strong bull markets, they may underperform. Over very long periods, they can lag pure equity growth. So this strategy works best for people who prioritize income now over maximum long-term growth. Many dividend investors use covered call ETFs as income boosters, not as their entire portfolio. The second approach is high-yield real estate investment trust, or REITS. REITS own income-producing real estate, apartments, offices, warehouses, mortgage-backed assets, and by law they must distribute most of their income to shareholders. This structure naturally creates dividends. Some high-yield REITs offer double-digit yields, especially mortgage REITs. These yields can look extremely attractive, sometimes pushing into the high teens or even above 20%. But higher yield comes with higher sensitivity to interest rates and economic cycles. When rates rise, REIT margins can get squeezed. During downturns, dividends can be cut. This is not a set it and forget it area of investing. That said, over long periods, REITs as a sector have produced average annual returns of around 10 to 11%, combining income and price movement. At a more conservative 10.8% yield, you'd need around $320,000 to $330,000 to reach $35,000 per year. REITs are powerful because they give you exposure to real estate without needing to buy properties directly. And many pay dividends monthly, which psychologically feels closer to a paycheck. The third approach is Dividend Aristocrats, the slowest but most stable path. Dividend Aristocrats are companies that have increased their dividends for at least 25 consecutive years. These are not speculative businesses. They are established, cash flow positive companies with strong competitive positions. Examples include companies in consumer goods, healthcare, and industrials. These stocks usually yield 5 to 7%, but they grow their dividends consistently. That growth matters over time, especially as inflation eats away at fixed income. At a 7% yield, you'd need around $500,000 invested to generate $35,000 per year. This approach takes longer, but it offers peace of mind. These companies tend to weather recessions better and maintain payouts even in difficult environments. Here's where most people get this wrong. They try to pick one strategy instead of building a blend. In reality, many successful dividend investors combine covered call ETFs for high current income, REITs for diversification and real assets, Dividend Aristocrats for long-term stability and growth. This creates a portfolio that produces income now, grows over time, and doesn't rely on a single risk source. But strategy alone isn't enough. The real secret to living off dividends is reinvestment in the early years. Before you live off the income, you reinvest it. Every dividend buys more shares. More shares produce more dividends. That feedback loop is where acceleration happens. This is why the early phase feels slow and plodding, and then suddenly speeds up. At first, dividends feel small, then noticeable, then meaningful, then life-changing. And here's something people don't talk about enough. Dividend income changes how you think. You stop asking, how much do I earn? You start asking, how much do my assets produce? That shift is everything, because once your assets can cover your expenses, work becomes optional. Not immediately, but eventually. And that's the real goal. Not yachts, not flexing, not early retirement just for the sake of it. Freedom of choice. So if $2,900 per month sounds ambitious, remember this. You don't build it overnight. You build it one contribution at a time. And once the system is in place, it keeps working, even on days you don't.